Welcome, everyone. Welcome back, I should say. Now we are into the session of Bank 4.0, Fintech's power to reinvent banking. Yes, you are in the right session. Folks, if you know, I know it's early for some, it's midday for others, it's late for even some others. It's dark where I am, but I am fired up for this session. This is my thing. I love financial technology. First, I have to give a little shout out to our sponsors, Winthrop and Weinstein, RSM, and Novogradac. Always got to do the business there. Some of you know, you know what? I think I actually have maybe a love-hate relationship, and maybe hate is a little, maybe strong. Maybe it's challenged with fintech because we deal with it so intimately at the bank. And if you don't know Sunrise Banks, we have two main business models. And both are grounded in technology in one way, shape, or form. One is probably what you consider, and most of our banks are. We have a place-based business model, branches, people, engagement here in Minneapolis and St. Paul, Minnesota. In that business is grounded in all sorts of technology. We also have a people-based business, which is really partnerships and collaboration with financial technology companies, as well as payment companies. And we like to think of it as fintech for good. And you know that I think that's maybe my love part of it is looking at financial technology and being able to scale good. It's more accessible, it's more convenient, easy to use and transparent, and you can price it fairly because it's so efficient. Sunrise does banks with the likes of, and we'll hear from John Scafano today from Remitly. It's a passbook savings account with the diaspora that remit money back home from the United States. Self is a credit building, savings building product. Gusto is actually the fourth largest payroll company in the US, and people can get access to their payroll or their wages sooner than payday without cost. And lastly, I'll just highlight maybe Employee Loan Solutions, which is a small dollar loan product with no credit check. It gives people access to credit for the first time if they have no credit history, as well as if they have poor credit history. Again, at scale, very efficient and responsibly structured. I have to say, one other thing that we're seeing in this technology space as well, it's not just partnerships with financial technology companies, but technology companies that can help us in our own workflow. For those in the United States, there's a paycheck protection program that's being offered by the US government in this time of COVID to help small businesses. And we were able to partner with a company called Anvil in that program to really help us automate a low-code workflow solution. It's really cool. So the other side, which as bankers and I think we all face, is we have legacy systems, and we're trying to work within those systems from a digital technology and transformation standpoint to seek simplification and modernization. And so the thing I think that we're seeing most is digital technology is moving fast, and it's not moving at a linear pace, but an exponential pace. And now with the likes of banking as a service capabilities, which I find are really cool, yet at some point in time, if I think of it from my traditional banker hat, that disintermediation of banking is really, I think, a threat to the strategy going forward for banks in the GABV. So I'm delighted to have Brett King with us today. He is the host of Breaking Banks. He will present us, I think, a timeline of banking, but as it bleeds into fintech, but then into the future of banking, called Banking 4.0. And then we're going to have a dynamic panel on financial technology. And you got to get ready, because I want your questions, your comments, your concerns, audience. My role in this session is to provoke. I know I'm the moderator, but I'm diving in. So between provoking Brett and the panelists and you, that is my job tonight. We're going to have a good dynamic conversation. So let me properly introduce Brett King. He is an international best-selling author, a world-renowned futurist and media personality. He has spoken in over 50 countries, given keynotes for the Web Summit, TEDx, Wired, TechSauce, Singularity University, The Economist, IBM's World of Watson. I think you get the picture. He has appeared on what I call the alphabet of networks: CNBC, BBC, ABC, 123. He's been there. Fox, Bloomberg. He's been an advisor to the Obama administration. He's been inducted into the Fintech Hall of Fame in 2020. Congratulations to him. I have to be honest, I didn't even know there was a Fintech Hall of Fame, and so there's something to look into there. King hosts the world's #1 Fintech radio show and podcast, Breaking Banks, 180 countries, 6.5 million listeners. He is the founder of Movin, a global mobile startup, launched the first in-app mobile bank account offered anywhere in the world. With that entrance and that introduction, let's give a listen to Brett King and Bank 4.0.
Hi, I'm Brett King, and I'm very grateful to be coming to you today on behalf of the Global Alliance for Banking on Values to talk about the future of banking and the post-COVID banking world. Obviously, I've spent a fair time in this industry over 10 years now, looking at the impact of technology. And one of the things that comes out of that is you start to see systemically some of the broader changes that are leading up to the future of banking. To be a good futurist, actually, you've got to study the past. It's very critical. So when we look at the formation of banking, or Bank 1.0, it really started to occur around the 13th and 14th century, most notably through the Medici Bank. And one of the oldest banks today, Monte dei Paschi, which was founded in 1472, was formed just a decade or so after the death of Cosimo Medici, the founder of the Medici Bank. So a lot of what we have in banking today stems from those times back in Italy during the Middle Ages. When we use the terminology for banking, the banco, the bench that the financiers and bankers used to sit on in the marketplace in Italy and so forth, you could be forgiven for thinking that banking hasn't changed much in those last 600 years or so. But in the 1950s, when we started to incorporate technology in banking, the changes obviously started to happen fairly rapidly. From the first mainframe computer in 1953, called IRMA, the electronic recording machine for accounting purposes, through to, in the mid-80s, the emergence of Bank 2.0, self-service era of banking, where we started to use automated teller machines, IVR telephone systems, and then eventually, of course, internet banking in the mid-90s. Now, what's common with these new channels that emerged on top of banking is primarily we just took the bank model based on branch and just retrofitted it to these new technologies. It wasn't until 3.0 came along with the emergence of the smartphone that we actually started to think about the design of day-to-day banking in a different way. How could we use these technologies to enhance banking in a way that wasn't really possible with traditional banking? And so you see the emergence of the first mobile challenger banks around the world. You see the emergence of mobile wallets starting to impact payments, social media networks and so forth being used in this manner. So we were starting to see for the first time a real divergence of thinking in terms of how banking would work and fit into our lives. Now, during coronavirus, we've seen, of course, an acceleration of the adoption of digitization. This is easily because people have faced lockdowns. They haven't been able to go to physical branches. There's been the risk of spreading the virus in these public places. So we've seen branch closures as a result of that. But more importantly, many people have been exposed to digital banking for the first time out of necessity. Now, whether or not we go back to some of those previous behaviors, history teaches us that is actually extremely unlikely. So it's more likely that the people who have been using digital during this period won't stop using digital to go back to their previous habits. There may be, of course, some balance to that, but ultimately we're looking at the long march to digitization having sped up a little bit. Of course, during this period, your ability to execute digitally has been pretty critical. Brands that were able to respond to these changes around the coronavirus and emphasize that from a service perspective in banking, we think will do quite well after the pandemic as a memory, because people will remember that they were prepared to help them. The PPP loans in the US are a very good example of that. Some very large banks weren't able to deliver on offering those loans to mid-size and smaller customers. But some of the community banks stepped up. I know inevitably when we're talking about digitization, we'll have the discussion about the role of branches moving forward. I'll make clear, I don't think that branches are necessarily going to disappear, but I do think that banks who are reliant on branches for revenue will disappear, because at the core of the transformation we see occurring in customer service and broader support right now is a fundamental change in the business models and economics of banking. Yeah, the largest challenger bank in the world today is based in Shenzhen. It's a bank called WeBank. They have 200 million customers, over 200 million customers, makes them twice as large in terms of retail customer base as JP Chase, the largest bank in the world in terms of market cap. And yet here we have a challenger bank that's 5 years old that has built up a customer base twice the size of JP Chase. How is that possible? Well, part of this is that digitization allows the creation of new banking and bank-like organizations at scale that can grow much more rapidly than through physical distribution systems. And the acquisition cost of customers in this model tends to be fractional compared with traditional branch-based customer onboarding and acquisition. So, for example, WeBank in China, their acquisition cost is $1.75 per customer. You look at Square Cash, not a bank necessarily, but a mobile wallet and P2P payments ecosystem. These guys pay around $20 to acquire a new customer. But JP Chase just a couple of years ago, in terms of acquisition cost, was measured at $350 per new customer to get them to open a bank account in a branch. At some point, the economics of acquiring customers in branch tend not to make sense in this world where digital acquisition is emphasized as a core skill or a core innovation theme. The question asks, well, if we acquire customers digitally, we still have branches, what are we going to be doing in those branches? Or how is banking going to be integrated? That's obviously the key question. That sort of brings us to, Bank 4.0 and the future of banking embedded in our world. So as I get into this, I want to talk to you about some core things we found when looking at innovation over the centuries. In terms of the most disruptive innovations or the most far-reaching impact in terms of technology, we find some similar things. And one example is of this type of engineering thinking that results in these highly disruptive inventions, if you like, is the concept of first principles engineering. So take the automobile. The automobile replaced horse and carts. It didn't try and improve on the cart or genetically engineer the horses. It replaced the concept of a personal transportation device with an automobile using an internal combustion engine. So this is first principles engineering. After that, personal transportation radically changed. City designs changed. They were all impacted by this move from the horse and cart to the automobile. In the space industry today, we see first principles engineering being used by SpaceX to create reusable rocket launch vehicles, the most reliable in history, to create rockets that are a 98% cost reduction in terms of the space launch platforms of the Apollo days in the 1960s and 70s, a 98% reduction in cost to orbit. This is incredible innovation, but only occurred through rethinking how rockets should be designed for the 21st century, including reusability, 3D printing rocket nozzles, and so forth. First principles engineering. Another great example of that is the Apple iPhone in 2007, the world's first smartphone. Apple didn't take the Nokia banana phone or the BlackBerry with the RIM keyboard or the Motorola Flip and take those and iterate on that. Steve Jobs and Johnny Ive started from scratch with an entirely new concept, a handheld multi-touch personal computer that you could also use to make phone calls. Now, these are all great examples of extremely disruptive technology based on first principles. The alternate form of engineering or innovation tends to be iteration. So taking an existing technology paradigm and improving it with available technology. So when the iPhone came out, we could have used this technology to really disrupt banking, for example, in payments. We'd always thought about the smartphone since its emergence, that it would be using NFC type technology and you would be using it instead of a plastic card. But we weren't that creative in terms of thinking about the design of a payment system based on a phone. All we did was stick a plastic card inside a phone. And this is fine for elongating the use of networks like Visa and MasterCard. But from an innovation perspective, it was just an iteration on the plastic card. In China, however, where they don't use plastic as much as we do in Europe and the US, as an example, we saw a radically different payments technology emerge, based initially on QR codes and now today based on facial recognition technology. The mobile wallets in China have far surpassed all of the plastic card use globally. Last year, in 2020, over $56 trillion of mobile payments, it's estimated, were made through two mobile payments networks, Tencent WeChat Pay and Alipay, both which have grown significantly during the pandemic as digitization of commerce has switched to mobile wallets as well. This is more than twice the size of the plastic card market globally, which is about $26 trillion estimated in 2020. So all of the plastic debit cards, credit cards, gift cards, GDPR, single-use cards, etc., that were used in 2020 accounted for less than half the transaction volume and transaction value on an aggregate basis with mobile wallets. Now, those mobile wallets are just not limited to China either. We see Kakao in South Korea, we see Paytm in India, we see M-Pesa in Kenya. The day-to-day bank account from a discretionary spending point of view of the world now is not a plastic card, a checkbook, or even cash. It's a mobile wallet. And that's a major first principles rethink of the day-to-day bank account that we see emerging before our eyes. When we've seen this happen in other instances, just like the automobile, just like SpaceX, just like the iPhone, the traditional model doesn't survive. This is a pretty big shift. Now, I know you might be thinking about, say, facial recognition that's used in China and say, well, civil rights, not sure that's going to happen here in the United States. But the reality is we've been getting prepared to see facial recognition in use for many years with science fiction movies and so forth that have highlighted this. This is Minority Report with Tom Cruise, produced by Steven Spielberg based on a Philip K. Dick short story. And we see iris recognition being used from an identity perspective. We see marketing behavior thrown in as well as payments included in that. We've known this sort of innovation has been coming for a while. And on the flip side, we have now concerns about use of cash in the retail environment because cash could be a vector for coronavirus as well. We've gone from these contact-based cash and cards to now facial recognition being used to create contactless payments capabilities and real-time payment capabilities. These businesses too grow at scale based on digital acquisition. And so Alipay, for example, has 1.6 billion customers today. There's no single plastic card issued by any bank in the world that could beat that today. But the use of artificial intelligence is going to be the next piece. So how will we differentiate bank accounts? It won't be based on the branch or the logo or the graphics of the plastic debit card. It's going to be based on intelligence. It's going to be based on how much this mobile smart bank account will respond to my life. I should be able to ask my bank in the future, hey, device, can I afford to go out for dinner tonight or with my friends over the weekend? And your smart device will know the answer. It'll be connected to all of your bank accounts in the cloud and will be able to act as a financial coach. We see in China disruption of even the savings model, the largest savings product ever for a financial institution in the world. Yui Bao was a mobile wallet-based savings account. It wasn't like a savings account that you got from a bank. You didn't have to fill out a form. You didn't have to go to a bank branch, sign a piece of paper. None of that. This was one click. You had money sitting in your wallet. Why don't you put it over in this other bucket where you can get some interest on it? That's how simple Ant Financial's Yui Bao savings product was. And at its height, it had over $300 billion in deposits. It was so popular, the central bank had to put currency controls in place and reduce the amount of deposit per customer because they were afraid it would have a negative impact on the market if something went wrong. Banking is changing based on behavior, devices, context. And this is starting to come into the design of products and experiences. So you walk into a grocery store in today's world, maybe you've got a debit card, you fill up your cart, you go to checkout, your salary hasn't hit the account, what happens? Your debit card's declined. And then you've got to go fishing for another card to pay with. But in the world of first principles engineering, I walk into a grocery store, my smart wallet knows how much I spent on groceries, knows I've walked into a grocery store, it knows my balance is low and I won't be able to pay for all my groceries today, and gives me access to credit as I walk in the store. No application form needed. I don't need to wait for a piece of plastic. This can happen contextually in real time. And with the emergence of technology like smart glasses, we expect the smarts of our smart bank accounts to really amplify, where we'll use image recognition and other technology like this to reframe our relationship to our money and our relationship to our bank. You might think smart glasses are sort of sci-fi, but this is Facebook's Project Aria that they've been working on over the last few years, including the technology they acquired with Oculus Rift and the Oculus devices. They intend to launch a set of smart glasses in 2022 to encapsulate this technology. This will be a personal computer you wear on your face and you interact with visually and through voice, and incorporates various AI and machine learning technologies like image recognition, where I can tell you where you left your keys because your smart glasses will have recorded that. In the world around us, as we interact, we'll have these, we'll have visual interaction through these head-up displays when we walk into a coffee store or a retail outlet of some type, where we get prioritization and recommendations around our previous behavior, or where we get safety warnings, walking on the street and when there's traffic and so forth. So these smart glasses are going to really lift up this level of smart banking and experience-based banking as we see this emerge in Bank 4.0. So the building blocks for the next decade or so in banking have already started to appear. But when we think about this sort of as an evolution of banking itself, we're going from this very informal, community-based banking, where we saw the emergence of very big financial services organizations. We used to call them universal banks. Then focus on digitization with omnichannel, and where this eventually leads us to is banking being embedded in the world around us when and where we need it, based on these technology capabilities. So as you see us move towards digital distribution, that is happening in every industry, and using this technology to reduce friction and create these compelling experiences, banking becomes something that is intelligent and embedded in your life with zero friction, low latency, real-time engagement around your bank account. If you need a signature on a piece of paper in this environment, you're no longer relevant. And so the new ecosystem that emerges for Bank 4.0 includes different types of organizations. The banks that have digitized and survived, the tech giants who own the technology layer, and specialist startups such as Fintechs who have the intellectual property in terms of behaviors and experiences and other things like that around banking and money use that have been implemented from a technology perspective. By 2025, we'll have seen a flip from the old days of credit card reward programs based on airline miles and cash back to more of a focus on your bank account, helping you save money to recover from the economic effects of coronavirus. Identity won't be your mother's maiden name, your social security number, and your date of birth. It'll be based on heuristics and biometrics, heuristics being your behavior. We're already starting to see this being used in fraud reduction, for example. By 2025, most people that carry a smart bank account on their phone will have never visited a bank branch. There'll be more digital banking users on the planet than anyone that's ever gone to a bank and signed a piece of paper, redefining what banking means. And by 2025, you'll get more advice every day from your smart banking layer through artificial intelligence than you'll get annually from speaking to a human, whether in a branch or, in some other manner. So when you add all this up, by 2030, the largest bank in the world is probably already with us for that period, and it's probably a company like Ant Group and Financial, because they can acquire at scale. They have the largest deposit bases in the world. They've got a whole lot more behavioral data that sort of integrates into the way they think about customers. And ultimately, that means they can integrate into our lives much, much better than a static bank who asks you to do the work and get through the friction. And that's the future of digitization of banking, and it's what I like to call Bank 4.0. Thank you very much for your time today and the opportunity to speak to you. I hope you found it interesting.
Very good. Well, Brett King challenges us as to what the future can be for banking. And so now I would like to bring our panelists in if we could. And Brett, I'd like to start with a question for you. And as we're getting that in there and getting our panelists together, just put together a few thoughts around that. It is a really challenging concept to think about our business models today in a Bank 4.0 scenario. And so oh, there we go. Just a minute. I think I need to unmute a few people. Okay, there we go. And so there we go. So in the banking 4.0 world, hard to imagine our business models today. Now, we're all on a different journey, I think, in terms of where we are from a technology play. Certainly, I think we would all probably say that our lives would be better without some passwords. But Brett, I'd love to pose a question to you in regards to the, as we think about banking 4.0, but and in regards to banking 4.0, when we think about impact, there was just a podcast on Breaking Banks with Jason Hendricks and Jennifer Tescher talking about impact banking. When does a consumer say, boy, as great and as convenient it is, I want to bank here, or I want to do business here because of their impact on the world, whether environmentally or socially? Does that come into the complex, maybe decision-making process of a banking 4.0?
And so forth. I think, ethical banking, moral banking. I think those are all things that are being drawn aware. We've seen some major brand names like Standard Chartered Bank more recently be very clear about the fact that they're not going to be supporting new fossil fuel coal-fired plants, for example, and things like that. So there's obviously some pressure coming on these banks to act more responsibly when it comes to their portfolios. But there are some broader questions that we could go sort of well beyond this, which is even does capitalism need to be reformed? Because we've got core problems of like inequality and other things like that are sort of underlying some of the issues we have in the financial services system. Ultimately, I think that if you look at the way we're going right now, we're capturing a lot of data about consumers and about companies, and so we've got that. On the flip side, that is going to have to force some sort of transparency in respect to business practices as well. I think the pendulum is going to swing the other way. And so that really means, I think, that we will be assessing corporations, not just banks, but corporations generally, in terms of their positive impact on the environment, their impact in respect to equality, and in financial services, certainly financial inclusion. That, of course, has business model implications. If you're a very old traditional bank, you've got a lot of, compliance and processes built around old systems. These newer players come in; they can offer solutions from an inclusivity perspective at a much cheaper operating cost, a much lower acquisition cost. So then you start to get the market making sort of adjustments based on what expectations are around those sort of things. But yeah, definitely, I think that's going to happen.
Very good. Couple of things. I want to ask you one more question, and then Aaron, I'm coming to you with climate fintech. George, just so you know, if you could, you may need to individually unmute everyone as you go around. So take a look at that. And so, Brett, a quick question for you. AI for good. Can AI actually be used for good, for inclusion? Where are your thoughts there?
Well, the whole thing about AI is that once you put it in place, you get extremely efficient operational capabilities. So there's strong incentives to use AI for things like credit risk management and so forth. But if you use the same basic, ways of assessing credit risk that we do today, you're going to incorporate those biases, especially if it's machine learning based, And so that's really the challenge right now is as we translate operations and as we translate regulation into AI models, are we passing them through some sort of filter, whether that's based on ethical conduct or removing gender and racial bias and so forth in that process. As a machine learning specialist or data scientist in a bank, you have to be pretty switched on to be able to try and figure out the right way to make that transition. However, I think the potential for AI is certainly to fix those problems once we have the intent to make sure that those biases don't cross over, right?
Yeah, very good. I could spend all day on that. I'm going to move on real quick. Aaron, tell us about New Energy Nexus. Let's start there, and then I want to get into the climate fintech report and touch base on its major findings.
Sure. Thanks, David, and thank you, Brett, as well. Some really important issues touched upon there. Just a high level, New Energy Nexus was formerly known as the California Clean Energy Fund. We support clean energy entrepreneurs with funds, accelerators, and networks. And actually, we were early supporters and investors of Tesla around the time that Elon joined. And over time, evolved. We now support programming in about 10 different countries with a heavy weight towards Southeast Asia. And because we're no longer a California organization, we have renamed ourselves New Energy Nexus, supporting accelerators in those places. So just to talk a little bit about climate fintech, as you all know, the last year has really been sort of an inflection point around what are called net zero commitments, or commitments to decarbonize from the largest corporations, as well as the financial system and even individuals. And so we've sort of set out to deliberately explore what tools and technologies sort of sit in this pathway to help those stakeholders on their journey and in their mission to decarbonize. And so climate fintech is effectively digital financial technology that catalyzes decarbonization. And so you're seeing these tools on a number of different levels and implemented within the banking business throughout different business units. So for example, you're seeing neobanks and even banking card products, which will reverse engineer your spending activity at the gas station. And it will calculate the carbon impact of burning that gallon of gas in your combustion engine. And then it will plant trees or provide offsetting to you so that you are now traveling in a net zero manner. As Brett mentioned, artificial intelligence now plays a really prominent role in lending and in the sort of consumer credit analysis and commercial lending practices. So you can now parse alternative data, such as someone's payment activity on their utility bills, and then decide whether or not they are someone who is bankable. Just to sort of finish it off, another huge trend right now is geospatial finance, which is the use of satellites to look at whether or not there is climate risk. Super important whether you want to insure or finance a low-lying portfolio of real estate that could be susceptible to flooding. And so just to wrap it up, climate fintech is sort of a umbrella term to bring together these digital financial technologies which are prioritizing decarbonization.
Wow. So both Aaron and Brett, I feel like I'm the human and the weak link in the chain in terms of where technology is bringing us in the future. I just have to make one moderator moment. George, if you could just take a look at the social live chat, it's probably in your lower right-hand corner, for instructions on how to hear the other panelists. I think that can help you. So Aaron, one more thing, and maybe I'm oversimplifying this, but as I think of the digitization of banking and financial services, how much decarbonization really is there? Is this a meaningful impact, as we have values-based bankers who are very interested in, obviously, climate change, but their own impacts? There's a lot of us right now studying the carbon impact of our loan portfolios in regards to a benchmark against the Paris Agreement. And so how do you, what does that look like? Is that a big impact if we were 100% digital?
Yeah, I mean, it's not just about, being digital and not having bank branches, but it's about the tools which you can implement in each business unit. So if you have a retail banking platform or a commercial banking platform, if you have an asset management business, there are tools now that you can plug into each of those business units, and it will help you source decarbonized projects and incentivize your customers to spend and save and invest in certain ways. So there's a number of tools out there. Nifio is one, which is helping to use AI to map against the Partnership for Carbon Accounting Financials, and using that to ensure that your loan portfolio is in line with those measurements and those rules that you are trying to adhere to. And there's just a lot of tools out there. I suggest everyone check out the Climate FinTech report. There's some tangible examples in there as well.
Yeah, and so if I'm reading you right, it's really about data. As Brett was talking about, embedding financial services in, there's also a data collection there, which also can obviously be used intelligently to map what the carbon footprint is and how to mitigate. Now,
That's right.
Cool. I'm going to move on to John and Remitly. John knows this, but Remitly is one of my favorite fintech companies in the world. But John, tell us a little bit about what Remitly does, and then let's go from there. Then I'm going to pepper you with some questions.
Awesome. I'm also still reeling a little bit from the love-hate thing being your customers. Us West Coasters are supposed to be the passive-aggressive ones, David. You're supposed to be the forthright Midwesterner.
Gotcha.
So Remitly was founded initially to disrupt the $600 billion global remittance industry. Our vision is to transform the lives of immigrants and their families through most trusted financial services on the planet. And the core remittance product for Remitly, we're a mobile-first provider of remittances and financial services to immigrants. Passbook is our foray into banking. This is how we accomplish that vision by helping immigrants specifically bank.
And so, John, in that space, so Remitly starts out in how many countries do you remit or connect money to?
We have over 1,000 corridors, which would be like origination to destination country pairs. And Remitly's bread and butter is typically going from developed nation to developing nations.
Gotcha. And in that particular case, so you go from a remittance product into a savings product. And so now you're providing that access for people to, and again, I'm going to go back to kind of that digital and maybe not quite 4.0 banking yet, but the fact is you have a certain amount of data on your customers already. Is that easily translated into the Passbook savings account?
So one of the most important things for our customer base is really about identity. And Remitly is really good at KYC. We're really good at identification and knowing who our customer is, and doing so without necessarily even needing a social security number. So that is one of the places where our core data on our customers translates extremely well and becomes a pretty important value proposition. But you've got other things too. You've got, and this isn't just about our customers, this is about anybody who's trying to use the platform, but you've got risk and fraud data in there. And then you also have some basic data around who's sending from where and to where. And so you start to get an understanding and a picture of your customer in a way that you can start to build products that really meet their needs in a way that traditional banking is not set up to meet the needs of an immigrant.
Yeah, and so when Brett in his remarks was talking about that identity and the biometric identity and so forth. So I think about identity as one of the two periodic elements that financial services kind of based on. If you know somebody's identity in real time, and they have collected funds, those are the helium and the hydrogen. I'm trying to remember my periodic table, of which all these other elements can happen. And so, do you see a future where there's an instant identity KYC that's almost instantaneous? Would you look at technologies like that?
Oh, absolutely. And I think also understanding it across borders too. So this is one of the interesting things about our customers. Our customer, because of different regulatory regimes, because of different essentially requirements in different places, this is why, if you open a HSBC account in the one country, it's not the same account in another country, right? It's a totally different set of things. And so that's where we're really trying to help our customers think, or help abstract and get the regulatory stuff. We take care of that so that you can just be the customer who experiences banking anywhere in the world.
Got it. Let's just take one. Aaron, I'm going to flip over to you for a second in terms of climate. Can you, again, I'm assuming it's all about the data about those customers. If you know the remittance is going from San Francisco to Marrakesh, then can you in the future, will you be able to deduct the carbon footprint of this on this end and that end and what it means? It's like a multiplier of money.
Yeah, it's a good question. I think there are current challenges right now where the powers that be can't agree that 2 + 2 = 4. And so getting everyone sort of on the same page around metrics and measuring and a taxonomy is sort of the first step into then being able to reverse engineer and measure each and every one of these things. You know, it's one thing for us in the States to make a certain calculation, you know, but if it's going to Marrakesh, you know, the Moroccan government might be calculating it differently. And so reconciling those two things is not so simple today. You know, Europe is a step ahead. They have a centralized effort around the European taxonomy and how to measure climate and carbon impacts. And so I think in due time, it will become easier for other countries and other regions to do the same.
Cool.
David, can I jump in on that previous point on KYC? I'm sorry, I hope you don't mind me interrupting, but
No,
you know, KYC traditionally, and I think, you know, if you look globally, and many of the people listening to this broadcast will sort of appreciate this, is KYC has been broadly exclusionary. You know, when it comes to access to financial services, you have to jump through this hurdle of getting your KYC done. Then and only then can you get access to a bank account. John's nodding because his business is built on this concept largely. But you know, one of the interesting pieces of that is that in the future, you know, KYC and the transaction will be together, right? You know, you'll be able to instantly create a value store as long as the KYC is there, and it won't matter, you know, from which bank account you're sending it from, whether it's a cloud-based value store on a mobile wallet, or whether it's a bank account with, you know, HSBC in Dubai. You know, that is not going to be matter. It's going to be immaterial when you're transmitting funds. So you won't have to do this KYC approval and setup first. It'll all be instantaneous. But that means these networks have to change. The payments networks have to change from being just payments rails to being data rails. So if you think about MasterCard and Visa today, you know, as an example, they do an authorization check to check whether you've got enough money in your account. But in the future, to be competitive, they'll have to send some basic KYC data, you know, sort of like a secure key thing to unlock the transaction. But the point of that is that KYC won't be a hurdle in the future. It'll just be embedded in transactions. CBDCs, smart contracts are all going this way.
So, Brett, I want to come to you with one question to follow up. George, can you hear me? Okay, I'm going to come to you in just 1 second. So, Brett, I got a question from the audience here, and it is, is Fintech something that the GABV banks should be afraid of? Is there a place for Fintechs and GABV or values-based banks in the future? What does that forward look? And I'm thinking of your concentric circles, but should we be afraid of Fintechs or should we be excited?
Look, I often get asked this in a different way, which is who's going to win, right? Is it the fintechs or the banks? And the reality is no one. I mean, when you look at systems like this, it's quite complex. But you have some fintechs already who are enormously successful. Look at Klarna, who just raised $1 billion this week for their incredible buy now, pay later tech that they're doing. Affirm is, likewise on track for IPO. And you've got some of, like as I said, WeBank, one of the biggest retail banks in the world by customer base. Ant Group, prior to the Chinese government stepping in there, prior to IPO, it would have made them the third largest financial institution in the world. But all of these organizations work with other banks and they work with other technology providers. And so that ecosystem that emerges is built around optimizing the utility of banking experiences, or optimizing how customers get access to this in real time. And so it brings together this ecosystem of these disparate players in the future. Fintechs require banks for revenue now as well, many of them. Banks, if they want to be able to innovate rapidly, they're going to partner with a fintech because a fintech can do it in a fraction of the cost and a fraction of the time of their own internal team. So there's a lot of incentive for these different players to come together. Which means, to sort of wrap it up, is that if you're a bank today, your one of the core skills you need to develop is the ability to partner with these external players that are based around these technologies. So you need to be cloud capable, you need to be API capable, and you need to have a division of the bank that really develops these partnerships and relationships.
Yeah, fantastic. Really appreciate that comment. George, I want to go to you. I want you to tell us a little bit about ESAF in your bank in India. Give us a little bit of background, and then I want to ask you some questions about how you're leveraging technology. I'm amazed at your growth. Give us a little background on your bank, and then let's go into technology.
Yeah, thanks, David. It's a pleasure to us to be part of the GABV Annual Conference. And as you know, we are the first bank from India to have the membership with the GABV in 3 years back. And along with me, my MD and CEO, Mr. Paul, also greeting all of you from India. And we're so happy that we are part of this panel discussion. ESAF, as you mentioned, the Small Finance Bank, it's a new specific segment of banks created by the Reserve Bank of India, the Central Bank of India, under the guidance of the Government of India. Now, with the objective of furthering financial inclusion by primarily undertaking basic banking activities to underserved and unserved sections, including small business units, small and margin farmers, micro and small industries. And one key thing they mention is, this all should do through high technology and low cost operations. So like any other universal bank, these small finance banks can undertake all basic banking activities, including lending and taking deposits or insurance. But the major focus is mentioned as inclusion with that innovative technology, so that can reach out the mass in India. And small finance bank, there's no restriction at all. If we can compare to universal bank and small finance bank, there are only few changes are there. For example, universal banks can offer loans to all customers, whereas small finance bank, they said that 75% of the loan should be under the private sector lending, which was defined by the Reserve Bank of India, like loans to the poor, MSME lending, agri loans. This all comes under private sector lending. So when a universal bank, their target is 40%, our target is 75%. And the capital to risk weight asset ratio should not be less than 15%. But the universal bank, for them, it's just 8%. And one of the specialty of small finance bank is that 25% of our bank branches will be unbanked rural areas. So this is the way where the small finance bank was designed and to reach the last mile. And on your question on technology, how technology help us to reach our financial inclusion objective. ESAF started microfinance way back in 1995. During that time, microfinance or microcredit was not a common word in India. ESAF learned the microfinance from Grameen Bank in Bangladesh and replicated the model in India with a few changes way back in 1995. As many of you know, that microfinance is a provision of financial services to low-income group, mainly who lack mainstream financial support. So till 2017, we are an NGO. We started as NGO, and then we moved to a non-banking finance company in 2008. And 2007 we became bank. So as a bank, we explored the opportunity of technology. Till 2017, 22 years, we were on manual mode. The client onboarding to collections, and everything is manual. Lot of paperwork in the field. Our staff has to carry at least 8 to 10 pages to enroll the customers. And usually it will take 4 to 5 weeks to onboard a group of 10 women clients and start lending. And 22 years, what we enroll is at 1 million customers. 1 million customers with $310 million US dollar of a portfolio. But when we moved to a bank, we got a license in 2015 and we became bank in 2015. We decided to capitalize the Fintech, the innovation technology, so that we can fulfill our objective. As I mentioned earlier, our target clients are economically weaker section. Mainly, they are not attending formal schooling. and after we focusing more on women and enterprise. So in order to displace our microfinance program, we took the advantage of mobile connectivity and unified identity. In India, we have Aadhaar. Aadhaar is a unified identity number given to all citizens of India. So we replace all the microfinance process into a tab mode. My field staff reach to the doorstep of the client for onboarding, sourcing the loan applications, opening accounts, and collecting.
So George, I'm just going to interrupt you real quick. I mean, your growth has been fantastic. It has been incredible in terms of the amount of expansion, and it sounds like the use of technology has been instrumental in that. I'm getting a couple of questions from the audience with just a few minutes left, so I just want to maybe change gears a little bit. And for each one of you, it's really around cryptocurrency. And where do you think crypto will be? And Aaron, I'm going to start with you, because when I think of crypto to start with, there's a heavy energy usage. When you in your fintech, climate fintech, do you contemplate cryptocurrency and its climate impact?
Yeah, it's a good question. Obviously, crypto mining has tremendous energy implications. So sort of solving for that is one challenge, but the application of decentralized ledger technology and tokenization does have a role in climate fintech, especially as you are measuring, for example, the performance of a solar farm. You can take that information and track it using crypto or some other decentralized means to verify that this asset is indeed where it is, where it's performing as you've expected it to, and then can be rolled into or securitized into bonds or other loan portfolios. So an interesting example, actually, recently, Steve Wozniak came out with a platform called F-Force, and that is a really interesting platform where they're enabling energy savings to be tokenized, and they're using crypto. Actually did a really successful initial coin offering, and there's tremendous promise with that particular solution.
Cool. Brett, you're nodding your head. What are your thoughts?
There's a great another example called the Sun Exchange. Aaron's probably familiar with it, where they actually created a token to measure the amount of sun that's generated on their solar panels, and you could then reinvest that token in buying more solar panels. So what would you call a token that measures energy generated by the sun? Well, they called it a RAR. I thought that's the best name for a solar coin that you could think of. But
that's awesome. George, I'm going to come to you in 1 second, but John, is crypto in the roadmap for Remitly?
Yeah, I'll speak as John, not necessarily as Remitly on this, but maybe a little bit of a hybrid of the two. Because I think if you want to be self-provocative, isn't crypto potentially the killer of remittances, right? You have a universal wallet that anybody can use anywhere. And so we pay attention to it. I actually think that crypto's got a ton of really interesting applications. Here's the big question for us, and I think that it is important, is what happens when you start to spend crypto? Right now, it's primarily an asset. And are central banks willing to essentially cede control of their own currencies?
Right.
And I think the answer to that is no. And so that always creates an interesting question about how do you go from crypto to a local currency, and what are merchants and other people in the country going to be allowed to accept and spend in country? And we just haven't gotten anywhere close to testing what that's going to look like.
Well, with the exception maybe of China's CDBC, which is now live, right? Because
right, but that's owned by that's officially regulated by the Chinese government.
That's the point, right? That's the point. Because Bitcoin, that was the design flaw in Bitcoin, because the 21 million, inflationary effect is it's become an asset class, as John has said, rather than being used for payments. So we need something that has higher value exchange potential than the current, cryptocurrencies.
Well, gentlemen, we have come to the end of our session, and I anywhere we go, we're going to find government, whether it's regulation or central bank, involved in this business. And so that's always going to throw, I think, a little bit of wrench into the technology space. And so in George, obviously, the Central Bank of India was instrumental in terms of the formation of your bank. I want to thank George, Brett, John, and Aaron today. I appreciate you taking the time. Thanks so much for your input. The Climate FinTech report, I think, is out there. You can hear Brett King on Breaking Banks. John, you're always there in Remitly. And George, wish you continued success in your bank and its growth. Thanks so much. Have yourself a wonderful day or evening.
Thanks, David.
Thank you.
Thanks, everyone.